In the private markets, trillions of dollars are flying around based on promises. Today, we're going to pull back the curtain on the engine that makes it all run. The critical difference between what's called committed and called capital. And look, we're not just going to bore you with definitions here. This is about understanding the real mechanics of how massive investments get made and why, in this world, a promise can be way more powerful than actual cash in the bank.
All right, let's kick things off with a number that's, well, it's pretty staggering. $2.62 trillion. As of mid-2024, that is the record-breaking amount of private equity dry powder, just sitting on the sidelines. It's all money that investors have promised to funds, but the fund managers haven't actually spent it yet. So the big question is why? Why does this massive pool of capital exist as a promise instead of actual cash sitting in a bank account? The answer is baked into the very system we're about to break down.
Okay, so to get our heads around that massive pile of cash, we have to look at the anatomy of the commitment itself. This is not some simple handshake deal. It's the fundamental blueprint for the entire private market, and it's all designed for one thing: maximum efficiency. Let's get into it.
So here's the absolute key distinction, the thing you have to get. On one side, you've got committed capital. Just think of that as the total amount an investor, the limited partner or LP, legally pledges to a fund. It's a binding promise, but really important. The LP is still holding onto the cash. Then on the other side, you have called capital. This is the chunk of that promise that the fund manager, the general partner or GP, has officially asked for. The promise has been fulfilled, the cash gets wired over, and is put to work buying a company or making an investment.
So why go through all this trouble? Why not just get all the cash up front? Well, it all boils down to one huge problem for fund managers, something called cash drag. See, if a fund manager took your entire $100 million investment on day one, but only managed to invest it piece by piece over a few years, all that uninvested cash would just be sitting there, earning next to nothing. And that inaction literally drags down the fund's overall performance, its rate of return. The entire commitment model was invented just to avoid this exact problem.
And look, this isn't just theory. You can see the impact right here in the numbers. In scenario A, if the fund calls all $100 million right at the start, it gets a 25% IRR. Not bad. But look at scenario B. By calling the capital only as it's needed, that IRR jumps to 35% for the exact same investment. That 10% difference is the cost of cash drag. And that's exactly why managers only want your money the second they have a deal to put it into.
Okay, but things don't stand still, right? This classic model has had a huge shakeup in recent years. The biggest change to this whole process in a generation is the rise of a financial tool called a subscription-backed credit facility, or for short, a subline. So what is a subline? Think of it as a fund's corporate credit card, but with an insane credit limit. A bank gives the fund a big loan, but the collateral for that loan isn't a building or a factory. No. The collateral is the mountain of legally binding promises from all the fund's investors. It's their uncalled capital commitments. This lets a fund borrow millions or even billions of dollars to close a deal instantly.
And this is how much of a game changer it is. The old way was slow and clunky. You'd find a deal, then you'd have to send out a capital call, wait maybe 2 weeks for all the money to come in, and then you could finally close the deal. The modern process completely flips that. Now, a fund finds a deal, instantly draws on its credit line to close it, and then, later on, it issues a capital call to its investors just to pay back the bank. It's all about speed and certainty.
But, and this is a huge but for investors, that speed has a very interesting side effect. By using a subline to delay the capital call, a fund shortens the amount of time an investor's cash is officially in the deal. Now get this, it doesn't actually make the fund more money in absolute dollars. But what it does do is juice the most important performance metric, the IRR, by anywhere from 1 to 3%. It's a financial engineering trick that every investor needs to be aware of.
All right, so we get the why behind the system and the modern twist. Now let's actually look at the nuts and bolts of what happens when a manager says, okay, I need the money.
Yeah, this isn't a casual email. It's a super formal, high-stakes process. As soon as a deal gets the green light, the GP calculates exactly how much cash is needed, figures out every investor's proportional share, and then issues a formal, legally binding capital call notice. And from that moment, investors usually have a really tight window. We're talking just 10 to 14 days to wire their share. There is absolutely no room for delay.
Which of course leads to the big what-if question. What happens if an investor just can't pay? What happens when that promise gets broken?
And let me be crystal clear here.
A capital commitment is not some flexible pledge you can back out of. It is an ironclad, legally enforceable contract that's spelled out in the fund's governing document, the Limited Partnership Agreement. Once you sign that paper, you are on the hook. Period.
Because if you break that promise, the consequences laid out in the legal docs are, well, they're brutal. They are designed to make you never want to default. The fund manager can charge you massive interest rates, force you to sell your entire stake in the fund at a huge discount, we're talking 50 cents on the dollar. They can strip you of all your voting rights and even ban you from any of the fund's future deals. The system is built on promises, but it's backed up by some serious teeth. Okay, so we've gone through the mechanics, the risks, the new tools. Let's tie it all back to today. With a record amount of capital just waiting in the wings, why is this so incredibly important right now?
Because that $2.62 trillion in dry powder isn't just some abstract figure on a spreadsheet. It's having massive real-world effects. For one, it means there's insane competition for good deals, which drives up prices for everyone. Two, it puts huge pressure on fund managers to get that money invested before their time runs out. And three, for investors, it can create a real liquidity problem if multiple funds all decide to call for cash at the exact same time. So, in this crazy environment, how do you even tell if a fund manager is doing a good job? You need the right measuring stick. And in private equity, that stick is called TVPI, which stands for Total Value to Paid-in Capital. It's pretty simple, really. It just measures the fund's total value, that's all the cash it's returned, plus the value of what it still owns, and compares it to the capital that investors have actually, paid in.
And this right here is probably the single most important thing to take away from all this. Your performance, your return, is not calculated based on your total promise, your committed capital. No, it's measured against the cash you have actually sent in, the called capital. If a manager takes $100 million of your cash and turns it into $200 million of value, that's a 2x TVPI. Understanding that distinction is everything when you're trying to figure out how a fund is really doing.
So, everything we've talked about, the promises, the cash drag, the sublines, the metrics, it all comes down to one simple, powerful question you should ask about any private market fund.
And that question is, when you show me your track record, are those performance numbers based on committed capital, called capital, or invested capital? They all sound similar, but believe me, the difference between them can be massive.
And you ask that question because the answer tells you everything. It cuts right through the noise and reveals the all-important difference between a good story and actual cash-on-cash performance.
This is not financial advice.